Hey everyone, it's PJ Patterson here for a market update on Friday, the 13th of November. Lucky Friday the 13th. Top three things today are going to be recovery and the Biden stroke vaccine bounce that we saw in the last 5 or 7 trading days or so, or the bounce and then the fade. The second thing will be our good friend, the US dollar, which I am spending a lot of time talking about, but again, it's critical to how we look at global macro. And then finally, inflation, what's happening with inflation and the quads conversation and where we're at with the quads. So let's talk about the Biden bounce. This past week, of course, we had uncertainty around the U.S. election. We had votes continuing to be counted post-election. Trump claiming, that there's been fraud, et cetera, but it becoming fairly apparent as the days wore on that Biden had won the key states that were still in the race and pushed him over the 290 or whatever it was electoral votes that he needed. So, or 270, I think. So clearly now we have a new president, who is the head of not new, but a different political party, being the Democrats. And there's going to be a whole new set of things that Biden's going to want to do. Now, the initial response by the markets was to have a rally, which probably makes sense because there was a lot of uncertainty going into the election, which we saw a bit of a sell-off leading into the election, which I took advantage of by buying up some stuff. Then we had the Biden bounce. And then we had a vaccine announcement from, I think, Pfizer, saying that they had something like a 90% success rate with the vaccine. And all of a sudden we had this big bounce. But I want to put that into perspective because, first of all, the U.S. still has rising COVID cases. It's actually getting more serious now in the U.S. and in Europe. So these are two of the biggest economies, of course, in the world. Europe as a whole is a larger economy than the U.S. and China. Individually, of course, you have all the states in Europe, and their economies aren't as large as singularly as the U.S. or as China. But together, Europe is a massive, massive economic area and an area that generates a ton of GDP to the world. So, point being that U.S. and Europe continuing to see COVID cases climb. We're now looking at the possibility that Biden may call for a total lockdown of the U.S., much like we had in Australia, New Zealand, and a few other places around the world, where they pretty much just said, you are locked down, you're sequestered, you're staying at home, you're going to stay there for 3, 4, 5 weeks while we get through this whole cycle and we stop the spread of COVID. Now, I don't know whether they're going to do that or not, but I'm going to talk about this in a moment. But if they do, that is going to impact in the very short term some things like oil consumption, obviously consumption of other key commodities and things like that. But I'm going to talk about inflation in a moment. But nevertheless, we are in very interesting and uncertain times around what Biden's going to do with all of this, but I think that's where he's leaning. So I guess I wanted to put it in the context of the markets and how they behaved and reacted to all the stuff that was going on. So again, we saw sell-off into uncertainty, into the election, the bounce as we started to see clarity around Biden being the victor. Then the vaccine gave us another boost, and now the market's starting to price in. Well, hang on a minute, starting to price in. We're not out of the woods yet, and if the U.S. goes into lockdown, that's going to mess up a whole bunch of stuff. So again, we're going to see how markets trade from here, and I'll talk about positioning in a moment. The second thing, of course, is the U.S. dollar. And I spend, again, a lot of time talking about the U.S. dollar because it is still critical and key as a leading indicator of what is going on around the world. Again, the dollar has inverse relationships between a number of things. I'm going to show you this chart, which I show a lot, which is the inverse correlations. And as you can see here, we still have some strong inverse correlations between commodities, the S&P. Gold now is fading a little bit, but over a longer period of time, you have that correlation. Anyway, the point is that I keep bringing up the dollar because as the dollar goes into continues to decline, it's always going to have little bounces and rallies. That's going to impact certain things like oil, gold, other commodities, etc. But the trend is still bearish. And it just really is going to create and give me opportunities to trade in and around some of the positions that we hold. Now, I'm just going to flick back up, to do all the flipping around on the slides. But I just wanted to show you a couple of charts of things that, again, have that inverse correlation to the dollar. Now, here's a big one, right? Bitcoin, for all of you who might invest in the cryptocurrencies or specifically in Bitcoin, you can see that Bitcoin has been on an absolute tear recently, and that's because the dollar's going down. So it goes without saying that if you'd invested in something like Bitcoin, as the dollar began to roll over, then you would have made a lot of money. But it's still, I mean, for me, I don't really mess around with the cryptocurrencies. I don't really like them. But anyway, maybe I will down the track. They're just a little bit hard to trade because you have to set up coin accounts and all that sort of stuff. But anyway, for those of you that might dabble in that stuff, you could very well continue to see Bitcoin rising over the next 3, 6, 12 months because of the dollar going down. Furthermore, and this is what I'm probably paying more close attention to, because I can trade it, because there's securities and instruments out there to trade it, is the CRB index, the commodities index. Again, it's been in an absolute bull market since sort of late May, early June of this year, when arguably the dollar topped, and that's probably when commodities have bottomed for this cycle. So we're continuing to see that rise. Oil, I don't think I have a chart of oil here, but oil is one that's been the last holdout. And in this last week, we've seen oil now begin to show signs that it is understanding and pricing in, number one, a falling dollar, number two, inflation, and number three, that at some point we're going to get back to oil demand going up, because people will again be getting out and traveling. They'll be hopefully we'll see air travel resume. We'll see more people driving around, traveling, etc. But as I mentioned in point number one, if we see the U.S. go into lockdown, like actually just say that's it, nobody's going anywhere, the only thing that'll probably be moving around are essential services like we had in Australia, and just very, very essential things, food, medical supplies, etc., that'll get moved around. So there'll be possibly a big constraint on demand for oil in the short term. I'm going to be looking to position and trade that because the energy trade now is back on. So energy in pretty much any quad except for quad 4 does pretty well. And energy, and I've got this S&P earnings growth table up because we've more or less now got every S&P, there's 50 left to report. But as you can see, the earnings growth is still negative across the S&P 500, which is telling again of the year we've had, that companies have had to clearly, well, not had to, but clearly we've seen in certain market segments where companies, maybe they're shut stores or the demand for their products have dropped or whatever. Other segments have done well. Obviously, if you look at healthcare, well, that you would have expected to see sales growth and earnings growth in the healthcare sector. But certainly in other sectors like IT, communication services, et cetera, you've seen the same thing. Now, energy, I'm not sure why there's a not measurable there. I don't know if that is because it's so bad that it's off the chart or what. I'm hoping we'll get an updated slide where that actually doesn't say not measurable. But if something's not measurable, then it's probably really bad. Anyway, I think what this is telling us is we are likely at the bottom of this market cycle for energy. And again, I'm going to be looking to reload positions, which I've sold recently for a profit in the energy trade on that Biden bounce and vaccine bounce, anticipating that I'll be able to get some lower prices here in the next few weeks as we see what the U.S. does with lockdown. Now, final point today, inflation in the quads. Well, I've already been talking about inflation, so showing you some charts of inflation. Now, if I had the individual charts of soybeans and corn and wheat and sugar and coffee and cocoa and all this stuff, they would all look very similar to this chart here of the CRB. So trust me, in the words of your former president of the U.S., believe me, inflation is here. And we're going to see growth and inflation now rearing its head. And this is becoming evident now in the fact that, and I don't think I've got no, I don't, but I thought I had a chart maybe of the U.S. 10-year. But one thing that's interesting is bonds have started to rise in the last week or so. And what that means is interest rates have begun to rise because bonds have been selling off. So the bond market now is starting to sniff out that we're going to see inflation. The gold market's doing the same thing. So gold is also now looking like it's in a neutral It's gone into more of a neutral trend and possibly is going to be turning bearish. So we're going to see bearish. We're going to be bearish potentially on interest rates and bearish on gold as we enter the new year. So this basically means I won't be in any more government securities or treasuries. We'll be pivoting into growth stocks, energy stocks, all of that sort of stuff. And some of that's already owned in your accounts. Now, one area of the world that's been red hot recently has been Asia. You know, I've been talking about this, and I don't have time today to find it, but Asia has been decoupled or has decoupled effectively from the U.S. Now, today we had a bit of a down day on the Asian markets, but in any case, they've been ripping to the upside. And I've been taking the opportunity, again, to trade around that a little bit. When we get a big run in the Asia markets, I tend to maybe pare back the position a little bit, but of late I've been adding to positions. And we're seeing across most of these Asian economies, China, Japan, Australia, Indonesia, Thailand, not Singapore, but anyway, I can't think of the other one that I was going to mention. But anyway, a lot of the Asian economies are going into quad 1 or 2. Now, these, again, are the quads where we want to be long growth. We want to be long things like energy. We want to be long pretty much small caps. Anything that is growth oriented, we're going to be long of that in quads 1 and 2. So again, I'm looking to a position for those things, or again, trade around them a little bit. That's why you're likely seeing a bit more activity on your trading reports. The good news is that I've been making money in a lot of these trades and taking small profits and profits along the way, and that's what we want to continue to do as I trade in and out of some of these. So at some point, though, I will likely just fully load and then sit tight. However, you know, it's always a good thing to take some profits off the table, because again, all of these things are related. You've got to be, if you're watching these videos on a regular basis, then you've got to now get a sense of the interconnectedness of everything. And there's some key players in all of this. So the US dollar, again, a very key player. So it's going to be something that's driving a lot of things. And of course, interest rates are another key player. And then the growth or the GDP of nations is another key player. That's sort of how we formulate the global macro strategies. Anyway, I'm not going to give you a primer on that right now. Finally, I guess I wanted to just highlight something that I've shown you before, but it's really interesting because we're starting to see some implied volatility discounts. Now, the reason this is important is because, and I want to draw your attention or your eyes here to a couple of these lines, right? Stop it. Anyway, here we go. I want to draw your attention to a couple of these lines on this table. The first one is this column here, current, and you can see a lot of red in there. And now what that means is it's got an implied volatility discount. And I wish I could get this thing to size correctly. There we go. There we go. And then I want you to look at 1 week and 1 month ago. And you can see 1 week ago, even 1 week, this is when we were getting the market uncertainty was being wrung out because it looked like we had a president-elect, et cetera, et cetera. We had all of these premiums in the market. Now, what was happening in the lead-in to the election, remember, is we had uncertainty. And what happens with a implied volatility premium is people are putting on protection after the market has sort of declined. So they were putting on all this protection a week ago because the market was going down, and now the market's has been going up, and they're getting complacent. Now, we haven't seen this level of complacency though in quite some time. So again, a lot of the sectors here are looking very, very complacent. This is one of the key reasons why I've taken a bit of cash off the table, gotten out of some positions, or pared back. Not in any of our Asian positions, because they've continued to do very well. And if you look here, for example, at Japan and China, you're still seeing and emerging markets, you're still seeing implied volatility premiums, which means people are generally that the markets there are continued to go up. So anyway, the final point on that is I'm just going to wait and see. What happens. Tech has been very interesting, and it's got a massive implied vol discount because it's been sort of going down of late, and people are now adding protection after the fact. So anyway, When this starts to shift back to green, that's when I'll start to buy. So this is where you want to sell. In other words, when you see a negative and it's red, you want to sell into that. And when it's green and when it's going up, that's when you want to buy. It's kind of simple like that. It's one of the metrics I use. Anyway, just thought I'd share that little lesson with you. So guys, have a wonderful weekend. As always, if you have any questions, want to catch up for a review or something like that, please let me know. And with that, I will say happy weekend and talk to you soon. Bye-bye.